This is level 1 of the CFA program, the topic on fixed income and the reading on fixed income securities defining elements. This is the first in a series of fixed income readings and really serves as an introduction. And you'll see the learning outcome statements. There's a lot of define and describe. But let me go ahead and start by trying to provide you with a solid foundation of addressing not just the LOSs in this reading, but then the LOSs in some future readings. So let's look at 3 questions. Let's ask who issues securities. Let's ask what do those borrowers do with the capital? And then finally, let's ask what do investors get out of being a bondholder from those issuers? So let's look at that first question. Who issues bonds? Well, governments, of course, issue bonds, and businesses issue bonds. So we'll take a look at corporate bonds and government bonds. What do those entities do with the capital? Well, corporations use it to primarily finance the investment in wealth-increasing projects, although the proceeds can also be used for other things like mergers and acquisitions, and maybe to pay a dividend, and maybe to change the capital structure on the right-hand side of the balance sheet. Governments issue bonds in order to finance their budget deficits. Now, the third question, what do bondholders get out of lending capital to these entities? And that's pretty much the focus of not just this reading, but then the future readings here in this topic series. But what investors receive is an explicit promise from the issuer that has 2 components. The issuer says something like, hey, I promise to pay interest and I promise to pay principal. Now, a lot of times those interest payments, and they're going to be called coupon payments, those interest payments are fixed, but they don't have to be. And then the principal amount in almost all cases is going to be $1,000 of a par value. And as you look through these LOSs, there's describe and compare and describe. What are we doing? Basic features of a fixed income security. We'll talk about the contract. We'll talk about covenants, maybe some tax considerations, cash flows, and then we'll end with types of bonds. So once again, this is really just an introductory reading. However, if you know and you learn and you understand these LOSs, excuse me, then this will lead you into success to future readings. All right, what is a fixed income security? So what did I say earlier? Just a moment ago, that a bondholder receives interest in principal. So notice what we have in bold there. Provides a return in the form of fixed periodic payments. So look down at the bottom of a timeline there. There's time period 0. And so at time period 1, 2, 3, and 4, and 5. So this is going to be a 5-year bond. And this is what we know about fixed income securities, is that they have a fixed maturity date. There's an ending date to the bond issue. Lots of corporations and governments issue bonds for 10 years or 20 years or 30 years. But, in recent past, and I'm going back to, maybe the 1990s, there are companies that issue 40-year bonds and 50-year bonds. In fact, 2 companies that you probably have heard of, Walt Disney and Coca-Cola, issued 100-year bonds back in the 1990s. And so what does that promise involve? So look at the bottom illustration down there on the timeline, that this bond is going to pay $40 every year for, in this case, 5 years. But if it were the Disney bond, it would be $40 for 100 years. And then on the maturity date of the bond, the bondholder will receive the final coupon payment or the final interest payment, and then the return of principal, which is why we have $1,000 plus the $40. Now, notice back on the way left under time period 0, there's a minus sign in front of that 1,000. That's going to be the price of a bond. And I think it's two readings ahead, maybe it's 3 readings ahead from what we're doing today. This reading is called something like, hey, how do we value a bond? And this is a good time for me to introduce it. We're going to value a bond just as the present value of the explicit promise, the present value of the coupon payments and the present value of the principal payments. So I'm going to have you get out your calculator right now with me, right? Get out your financial calculator and let's go ahead and work through this just quickly. This is not part of the LOS here in this reading, but it will be in a future reading. So the earlier you learn this, the better. So what I want you to do is I want you to find those 5 time value of money buttons across the top of your calculator. You know, they read things like PMT and FV and I. So let's do this. Let's do the 40, right? Let's do 40 and hit PMT. And that's our coupon payment. That's the ordinary annuity. Let's hit 1,000 and let's hit future value. And let's do 5 is N. And then we need an I in here. And what's happened in this question here on the slide is we haven't really given you much of an I. But let's go ahead and just assume that this I is 4%. So do an I, so do 4 of I. And then we're going to solve for present value. And let's just hit present value. And lo and behold, what do you get? Oh my goodness gracious, you get $1,000. So that's the price of this fixed income security today. Now, I'll go over some really, really good examples in future slide decks. But for now, let's remember that the price of a bond is simply the present value. So price and present value mean the same thing. The present value of those future cash flows. Now, let's quickly go through some of these bullet points here, also called debt securities, right? Fixed income, bonds, debt securities, right? We know that. The payments of a fixed income security are known in advance. Of course, when Coca-Cola or Walt Disney issues this bond, they'll say something like, hey, we're going to pay you 4%. That's called a coupon payment. A 4% coupon rate will pay you $40, 4% of $1,000 every year for 100 years. Now, in this case, it was just 5 years. So when you read, as a bondholder, when you read the prospectus or look at the indenture, you'll read all of these terms: 100-year bond, 4% coupon, etc. Now, here's just a quick picture of an illustration of what, and this is probably pretty much in the old days when corporations and governments would issue bonds, they would actually, give you a certificate. And so there's a coupon rate on there, there's terms, there's all sorts of stuff in there. All right, who are the issuers, right? So this is what we said. Issues can be governments, corporations, other legally recognized entities. We'll talk about them in just a second. And they can be these supranational organizations, so sovereign governments, both at the federal level and at the local level. But then oftentimes there are groups of organizations between and among countries that get together that can issue bonds. So what they do is they say, hey, you know what? We need a bunch of money. Maybe it's 100 million, maybe it's 5 billion. And what they do is these issuers appeal to bondholders throughout the world. And they do this in increments of $1,000 so that you and I can afford to buy any kind of a bond. So just think of this bond issue as a loan. What do you and I do? We go down to the bank and we borrow money to buy a car and to buy a house and to help our children pay for their education and all sorts of other things. Well, corporations do the same, but they issue a bond so that they can raise huge amounts of capital. I mean, imagine if we wanted to borrow. Let me just come up with some crazy number here that even Hollywood people couldn't imagine. Suppose we wanted to borrow $6 billion to build a house. I can't even imagine what that house would look like. But if we went to one bank and said, hey, can you lend us $6 billion to buy the house? Even if we were super wealthy, right? The bank would say, gosh, that's way too much. We'll lend you $200,000. So then we'd have to go to a whole bunch of banks to raise that capital. And this is what the bond market does for us. Here we go. Maturity. You already know this. What's that second bullet point read? Typically range from overnight. Now, overnight securities, those are short-term kind of fixed income securities, but 10 years, 20 years, 30 years, or all the way up to 100 years. Now, here's a good definition. So money market securities have a maturity less than 1 year. And money market securities typically do not pay a coupon or an interest payment. But those that mature in 1 year or longer, they typically do. And there are some crazy bonds out there that go against everything that I've said here in the past few minutes. These are called perpetual bonds. In England, they call them consols. They were fairly popular, maybe 50 years ago or so, but I don't know that the consols are issued much anymore because there is no maturity date. They just go on in perpetuity, kind of like a share of stock. Let me tell you a quick personal story. In 1981, when I was sitting in my very first financial accounting class, a professor, and by the way, I was in such a big class that there were, I don't know, maybe 3,000 people in this gigantic auditorium. And the professor kept saying something like, okay, a bond has a face value, and a bond has a principal, and it has a maturity value, and it has a par value. And he kept using all these terms. And I was thinking, man, this is a lot of terminology. And I thought, why does he keep changing? They all sound like they're $1,000. And I was tempted to raise my hand, but, back in those days, I was a little bit shyer than I am now. Plus, there were thousands of people in there. So I read the book, read the textbook. That's always a good thing. And it said, hey, these things pretty much all mean the same. And in almost all cases, that par value is $1,000. Coupon rate, this is what I was saying. Think of the coupon rate as the interest payment. We're going to get the coupon payment from the coupon rate. And what did we do back here? Let me just go back and remind you quickly here. So notice we have $40 every year for 5 years. So this was a 4% annual coupon rate. You take 4% times the 1,000 to get the annual coupon payment. And that annual coupon payment is the interest payment. Now, notice that second bullet point down there. Most bonds, they're kind of considered conventional bonds. Most bonds pay a fixed coupon rate. But organizations, corporations, and governments, they don't have to pay a fixed 4% for 5 years, or Disney doesn't have to pay a fixed 4% for 100 years. I mean, they could make it up. They could say, look, I'll pay you 2% first year, I'll pay you 12% the second year, I could pay you 40% in the third year. But bond issues typically aren't that crazy, and so they're typically fixed, but they can also be floating. And look at the bottom arrow point. Floating rate consists of a market reference rate plus some type of a spread. And that market reference rate historically has been LIBOR, the London Interbank Offered Rate. But I'm guessing that many of you know about LIBOR and the scandal. And so we're moving away from LIBOR and we're moving towards other kinds of market reference rates. One of them is the secured overnight financing rate, sometimes referred to as SOFR. And there are lots of other rates out there. I mean, I could come up with my own Jim's reference rate if I wanted to. But essentially, those reference rates are short-term rates that involve somehow bank-to-bank loans that probably have a very short-term maturity. So we start with that rate, and then we add some kind of a spread that reflects things like, maybe default risk on the bond. And we'll talk at length about that in future readings. As you can imagine, bonds can be issued in any currency. Of course, they can be issued in New York or London or Tokyo. Even Santa Claus could probably issue his bond and call these the North Pole bonds. But lots of these large corporations like Disney and Coca-Cola that I mentioned earlier, they have the power, the magnanimous ability to issue bonds in different currencies. And so dual currency bonds, they can make coupon payments in one currency, and then they can pay the par value in some other kind of currency. And so there's really nothing preventing Walt Disney from issuing a bond, with Santa Claus at the North Pole or in Tokyo or in Australia, and then using the proceeds, converting them to another currency. It wouldn't have to be the US dollar, could be the Canadian dollar, could be, whatever currency Santa Claus uses at the North Pole. So what this does, of course, and we're going to learn this throughout the CFA program, is that these large corporations, they're going to issue bonds in the market that gives them the lowest possible interest rate, right? What's the goal of the business? Maximize shareholder wealth. One way to do that is to borrow money at the lowest possible interest rate. And that's what dual currency bonds provide these mostly larger corporations. Now, lots of bonds have what's known as an embedded option inside of them. Lots and lots of bonds are just conventional bonds. I promise to pay coupon, I promise to pay principal, and there's nothing fancy about it. But some bonds have what are known as embedded options that gives either the bondholder or the issuer certain rights under certain conditions. And so a currency option bond gives the bondholder the right to choose the currency. So I could buy this Walt Disney bond and I could receive coupon payments in dollars. But if it's a currency option bond, I could say something like, hey Walt, I want my coupon payments in the Canadian dollar or whatever currency is out there. And of course, there really are almost no limits to what a currency option could be. I mean, you could receive half of your coupon in dollars and half in Japanese yen, or you could, what we're going to be moving towards at some point is you could receive half in a cryptocurrency, you could receive half in some other currency as well. But for the reading, just remember, it's probably one currency or the other. Now, remember when I had you get out your financial calculator and we computed that $1,000? We hit 4 for the I. Well, we need to distinguish between the coupon rate, which gives us the dollar amount of interest, and what is known as the yield to maturity on the bond. Now, in the case that we just did with our financial calculator, we had a 4% coupon rate and a 4% yield to maturity. 4 and 4, that's why the price of that bond turned out to be $1,000. So let's go ahead and define this yield to maturity on the bond. It is, oh my gosh, didn't we do internal rates of return back in our time value of money stuff? So a yield to maturity is really just the IRR that forces that present value of the bond, the price of the bond, to equal to the present value of all of those expected or promised payments. And that's called the yield to maturity on the bond, which is a function of risk, let's say. And we'll talk about all those different kinds of risk. But what happens to yield to maturity over time? Sometimes it goes up and sometimes it goes down. That in and of itself causes the price of the bond to change from that original $1,000 that we computed just a few moments ago. Now, don't get yield to maturity confused with current yield. Current yield is simply taking the annual coupon payment divided by the price of the bond. That's called the current yield. So think of the bond's price. That's the current price, right? That's the market price. So current yield, you take the fixed coupon payment and put it over top of the current price and you'll get current yield. And this is a great exam question. I do this all the time to my students. Make sure that students and you candidates know the difference between coupon rate, yield to maturity, and current yield. Now, remember what I said at the introduction. I said something like, what the issuer does is make an explicit promise. And I picked that term specifically because the explicit promise has its basis in legality. And so what we call this bond indenture is the legal document that outlines the obligations of the issuer. And so pretty much the document, I mean, it's, you can read these things. They're thousands of pages long, not quite thousands. I exaggerate a lot and embellish, but they're long documents. But somewhere in there, they have the coupon rate, the maturity date, and any right of the bondholder, which involves some of those embedded options that I talked about earlier, or some other kind of features that we'll do here in a slide or two. Yeah, so notice what happens down there in that bond, in that illustration that we have. So over on the left-hand side, we have the issuer, right? The corporation or the government entity. Over on the right-hand side, under the blue, we have the bondholders. Those were kind of us, thinking about us as the bondholder. And so this is the image that I give my students all the time. I say, hey, this is what the executives of a corporation do, or what the representatives of a government do. They pick up the phone and they call the bondholders and they say, hey, can you lend us a bunch of money? We're going to do this and this with it, and I promise to pay you coupons and principal amount. And so I give my students this kind of, an image that illustrates the intimate relationship between the issuer and the bondholder. But then I tell them that, of course, this really doesn't happen. I mean, the executives don't pick up the phone and call the bondholders because there's a middle person in there. So there's the trustee. It's probably some kind of a financial institution that does lots and lots of stuff. And inside of those trustees' obligations are to making certain that the issuer over on the left-hand side does all the stuff that is outlined in this legal document, and that the bondholders get all the stuff that they are duly and legally the rightful owners of. Let's see, a plain vanilla bond has a standard template. Yeah, sure, that makes a lot of sense. Exotic bonds have tailored and long indentures. So this can be, what did I say earlier, 1,000 pages. Well, I promise you, unless you're a lawyer, you don't want to read all these things. But it's probably worth it to do a quick search just to take a look at this for 10 or 20 seconds. All right, so what was that first one? Legal entity of the bond issuer. So we did all that. So it's the corporate legal entity, or it could be a holding company. Remember, financial institutions, a lot of them have what they call financial institutions, holding companies, or bank holding companies. And then look on that bottom right. Boy, we'll talk a lot about these special purpose vehicles or special purpose entities, where these corporations, they create this new legal entity and they throw some assets in there, and then they use the assets as collateral to issue a bond. And so the bond indenture has to tell us all about that. This is a source of off-balance sheet financing that, it's really a cool source of financing. It really does lots of really great things to transfer risk. The problem is that we need to make sure that we know everything that's going on about that. Think Enron. Those of you who are old enough to live through Enron, somewhere around the year 2000, they had a bunch of these special purpose vehicles, and they told us that they threw a bunch of assets into this thing, but they didn't throw any assets in there, and they ended up borrowing a lot of money, and they faked us all out. All right, source of repayments. All right, you ready for this? So corporations issue bonds. What did I say earlier? To invest in wealth increasing projects. And so what do those wealth increasing projects do? Well, they generate cash flows. So corporations repay these bonds by the cash flows from operations. Now, governments, on the other hand, they have an interesting kind of a source of repayment. If this is a federal government, then what does the federal government do? It issues these bonds to, what did I say earlier? To finance budget deficits. Well, the federal government can always just raise tax rates and impose taxes on all sorts of people out there to repay these loans. And of course, that works down at the local level too. Here in the United States, we have 50 states, so states can issue bonds, and cities can issue bonds, and counties can issue bonds. Some countries call them provinces, and they have other names. But look at that second arrow point, supranational organizations. So what did I say earlier? That these are organizations that take components from different countries. These are supranational, so in between or among nations. And I always tell my students about one of my favorite supranational organizations called the African Development Bank. And what the African Development Bank does is they issue a bunch of bonds. And I encourage you to go to its webpage, because they issue bonds to help all of the people who live in Africa. And so they have agricultural needs, they have water needs, they have social needs. And so they issue bonds. And these bonds have, they can have a fixed coupon rate, they can have a floating coupon rate, they can mature for 10 years or 20 years or 40 years. But what they do is they make capital available, and they make loans to individuals and other organizations who have these entrepreneurial ideas about how to improve the quality of life in the continent of Africa. And so how does the African Development Bank repay its bond issue? Well, through all of the loans that it makes and all of the programs that provide cash flows. And then skip down to the bottom. Boy, we're going to have great conversations about asset-backed securities. Now, this is probably an introductory concept to many of you, but asset-backed securities are a larger asset class. One security inside of this is known as a mortgage-backed security. I bet you know all about mortgage-backed securities from the financial crisis in 2008. How about collateral or backing? And so a lot of corporations, they can issue unsecured bonds. They can just say, you know what, we're big enough. We don't need to tie anything to a specific asset. But many corporations and many bondholders prefer that there is some kind of a backing. So senior ranked bonds, these are probably secured bonds that are secured with a specific asset. So you think of Walt Disney, what does Walt Disney do? What kind of assets? I mean, it has the theme park, right? And it has TV, and it has movies, and it has production sets, and whatever else goes into that. So they could issue a bond and tie that to the asset, so that if Walt Disney couldn't repay the loan, then the bondholders would force them into bankruptcy court, and the judge would say, okay, you now have possession of a theme park, and the bondholders don't really want to run the theme park. They would sell it. Different types of collateral in terms of the legal document inside of this indenture. Collateral trust bonds, mortgage bonds, equipment trust certificates. Those equipment trust certificates were pretty much the origination of collateral. These go way back, 150 years ago to the railroad industry inside of the United States. And there are tons of these today because, like the airline companies, they pretty much use these equipment trust certificates because they don't really want to buy the entire airplane from Boeing or whoever else makes the airplane. What they do is they put this airplane into a trust, and then essentially what the airlines do is they lease the asset and they repay it, and there's some provision which they can actually take ownership of the airplane over time. That's an equipment trust certificate. So mortgage, property, and covered bonds, collateral trust. Just think of any kind of an asset that an organization has, that a corporation has, that can be used as collateral. Credit enhancements. These are super cool things. Let's suppose I issue a bond for let's just say $1 million, and I use an asset that I have that cost me $1 million. I mean, that makes sense, right? Well, the bondholders are going to take a look at me, and then they're going to take a look at the asset, and they're going to say, boy, there's some risk involved there. Maybe it's not nearly as collateralized as we would like it to be. So the bondholders might look at me and they say, hey, Jim, you know what? We want more collateral. We want that asset. Plus we want a bunch of other assets in there. So this is called over-collateralization. And here's the example that I always give my students. And I've used this in examples for level 1 and level 2 recordings. But I tell my students, I say, look, let's go back to one of my favorite movies from the old time days, and maybe a movie that you guys have seen. I'm referring to the Pink Panther movies. So you remember Inspector Clouseau was trying to find this stolen Pink Panther diamond, which was priceless. So imagine putting the Pink Panther diamond into a trust as collateral for $100 million bond issue or whatever it is. This is an example of over-collateralization. So when you get to the exam and you get to a question on this, think of Pink Panther and then give yourself a chuckle for Peter Sellers and Steve Martin, who are super funny in those movies. And I promise you won't get this question wrong, right? How's that for a loose promise? And there are other ways to do this. You can do credit tranching where you slice it into different tranches. We'll talk about that at some other recording. All right, covenants. These are really cool things that add value to the bond issue for both the borrower and the lender. So notice what we have there in that first point. Legally enforceable rules. that both parties agree on. And so these can either be in the affirmative or in the negative. And so the affirmative, of course, the name suggests that somebody has to do something, right? And so the great example is when a corporation issues a bond and they say, hey, we're going to issue this bond and we have this terrific idea over here for a positive NPV project. We're going to invest it in this new product line. So we're going to use the proceeds to do this. And so remember we had that illustration in the middle for the trustee. So the trustee is going to make sure that the company borrows the money and then uses it for those specific proceeds. And then some other minor ones are something that sounds like, you know what, as a bondholder, we're trusting you with our capital, so why don't you trust us? Why don't you hire some really good financial accountants so that they can go through the financial statements and audit them and put their stamp of approval? So those are examples of positive covenants. But then there are negative covenants. And so if you're my bondholders, you might say to me, all right, Jim, we're happy to lend you the money, but we don't want you to do this and this and this and this. Because if you do this and this and this, then we might not get our $40 from that earlier example. Yeah, so look at the examples we have at the bottom. You cannot sell certain assets. You know, like that asset that's in the trust, that's in the collateral. You can't sell the Pink Panther diamond without our approval or without our knowledge. You can't take over another company. You can't pay a dividend, or you can't increase the dividend by more than 10%, or you can't do this, or you can't do that. So remember positivity and negativity. How about tax implications? So what do we know? At least in the United States, we know that when we receive an interest income, that's generally taxable. Well, you know, here in the United States, we have certain rules. So if I buy a U.S. Treasury bond, I might have to pay federal taxes on that interest, but I might not have to pay taxes on my state or my local returns. And so just remember that there are different ways to think about taxation. And it depends all on where the bond is issued. And of course, this gets more complex when we go to foreign markets. Now, a euro bond is not a bond that's issued in Europe. It gets its name. And so a bond that's denominated in a currency that is not the domestic currency. So if Walt Disney here in the United States issued a Santa Claus bond up at the North Pole, that would be called a euro bond. That's why we have that second bullet point there. That third one is probably important. This is a great exam question. Less regulated. They probably don't have the Pink Panther diamond in there for collateral. And then we're probably going to need the use of financial institutions that operate in different countries. And of course, I couldn't get through this slide deck without referring to one of my favorite movies. It's one of my wife's favorite movies out there. Maybe it's your favorite movie. Do you remember old Bruce Willis? He gets involved in this big old plaza, and these bad guys are in there, and they're trying to drill through a safe to get German bearer bonds, right? $600 million in German bearer bonds. And those bearer bonds means that you actually have to bear the bond. You have to take physical ownership. And so most of these euro bonds are bearer bonds. So there's another piece of advice for the exam. When you get to a bearer bond or a euro bond question, think Bruce Willis and Die Hard. So this is what I was saying earlier about the taxation and the globalization here. So of course, the income, the coupon payment is going to be potentially taxed. Look at that third bullet point there, what I was saying earlier. So if I buy a U.S. Treasury bond, I have to report that on my 1040 that goes to the federal government, to the IRS. But I don't have to report that when I put my state and my local taxes. And of course, municipal bonds, they have tax advantages as well. So remember, there are different tax implications. Remember, the CFA Institute, they're not requiring us to become, tax lawyers or tax accountants. They just kind of want us to know general ideas about taxability. But capital gains tax, so if we buy low and sell high, that probably generates a capital gain. And maybe we pay a different tax rate, but we're probably going to have to pay taxes on it. All right, principal repayment structure. So notice what we have there. We have the coupon payments there, so those are annual. But then at the very end, this is a lump sum future value payment. It's going to be $1,000 per bond in almost all cases. And so the question then becomes, how does a company make that final lump sum payment? A lot of people refer to this as a balloon payment. I always tell my students, I use the terminology, think of it as a big matzo ball payment out there, right? The corporation or the government is making these small payments every year, right? What did we have in that first example? $40 and $40 and $40. It's probably really easy for the corporation to generate at least $40 in cash flow to be able to repay the bond issue, right? But where on earth are the executives going to come up with $1,000 per bond, which of course translates into 100 million or 10 billion, whatever that par value of the bond is? Where is the organization going to come up with all of that money? How do we repay? Well, of course, the obvious answer is that, boy, this asset is going to generate lots of cash flows over the life, and we'll just have that money available. But bondholders would be less likely to lend the money, to lend the capital to the issuers initially if they were just promised some general idea that, oh yeah, hey, don't worry about it, we'll be fine because this asset is going to pay off over time. Now, let me go back here real quick. So lots of bonds are unamortized, which means that the corporation and the government just makes interest payments. So this is like an interest-only mortgage. Well, lots of bonds can be amortized so that once the corporation makes the coupon payment to the bondholders, then they make fixed periodic payments that reduce the outstanding principal. And so what this does is that this just it lowers default risk or credit risk to the bondholders. So look at that first arrow point. This is exactly what I was saying. It's similar to a mortgage, right? When we have a mortgage, we pay interest and principal. And so some bonds can be fully amortized, which means that at the end, with that last payment, then there's a zero balance, but they can be partially amortized. And so notice we use the term balloon payment, but the first thing in an unamortized bond, that balloon payment, that's a gigantic balloon payment. And with a partially amortized bond, the balloon payment is going to be smaller. Now, of course, you'll read about all this in the indenture as a good bondholder. And so the balloon payment could be this balloon, or it could be this balloon, or it could be a gigantic balloon. So here's just a simple illustration of coupon and principal. Now, of course, we can do this even more formally with creating something called a sinking fund payment or a sinking fund. And what this is really nothing more than a savings account. And it looks a little bit like the illustration from before, but the sinking fund is actually a separate legal entity. And so what corporations will do, let's go back to Walt Disney. Walt Disney will pick up the phone and call a financial institution and say, hey, we want to set up a sinking fund. It's like a trust fund. And so what we're going to do is every year or every 3 years or whatever it is, we're going to send you a bunch of money. And we want you to invest it. And then when the bond matures in 100 years, right, that Walt Disney bond is 100-year maturity. In 100 years, we want you to send us our 400 million or 600 million, whatever that future value is. So look at the first arrow point. It's a cash reserve. We send it to the trustee. And what it does is it allows the corporation to retire either the entire amount at one time or in increments. Yeah, good advantages. Formal plan, reduces credit risk. I said that. Disadvantages, reinvestment rate risk. I'll talk about that in just a second. But how about the issuer may have the option to repurchase the bond below those market prices. So this is what's known as a callable bond. And so there's some disadvantage to the bondholder in that the bondholder might not receive all of those payments at maturity, but might receive them before maturity. And then, of course, if the bondholder receives that maturity payment before the maturity date, then it has to reinvest that in probably a lower interest rate bond. right, so those conversations that we just had, those were pretty much fixed rate bonds. But what did I say earlier? We can have floating rate bonds where the interest rate floats upwards if interest rates are rising and floats downwards if interest rates are falling. There's my reference to LIBOR, but the reading, I'm guessing that the CFA Institute will catch up to LIBOR being out of favor at some time in the near future. And so what happens is that the coupon rate will go up when interest rates go up. How about if I say it a different way? The coupon rate will rise when the yield to maturity on the bond rises. And so when what happens with these floating rate notes is that they almost always sell around the par value of $1,000. That's why that second arrow point, unlike plain vanilla bonds, these floating rate notes are less affected by changes in interest rates. And that's what I meant when I said that the price is going to be somewhere around $1,000. In fact, on the date in which the coupon paid is set, then the price is probably going to be $1,000. Now, some of these bonds have an embedded option in them that says something like, okay, coupon rate is 5%, and if yield falls, it'll be 4%. If yield falls, it'll be 3%. If yield falls, it'll be 2%. Wait a minute. We have a floor in there. It can never go below 2.5%. That's a floor. And of course, there's some bonds that could have a ceiling. There could be some bonds that have a range. I mean, these embedded options are really the coolest things about the bond market and the fixed income security market, because you can put an option in there to do almost anything. I mean, think about it. You could be a bondholder and you could say to Walt Disney, you could say, look, when you pay me that 5th coupon payment 5 years from today, I want to have the option of receiving that coupon payment in US dollars, or I want to receive tickets to Disney World in Florida or California or France or whatever it is. So you could create a bond that has almost any kind of an option in it, although I'm pretty sure you can't do it the way I just suggested. Lots of smaller corporations and maybe medium-sized corporations, what they want to do is make the bond more attractive, but they don't have enough cash flows to make it attractive today. So what they'll do is they'll say something like, look, send us your money today. Let us borrow your capital. We're going to invest in this super asset over here. It's going to generate lots of cash flows, but we have competition out there. And in the first couple of years, we're going to increase our market share by 1% and 2% and 3%. So we're going to pay you a 2% coupon rate for 3 years. But after that third year, when we become super profitable, we'll increase that to 4%. And then after 6 years, we'll increase that to 8% or some big number. So this is called a step-up bond, in which the coupon rates are set to increase. And you could have, Walt Disney could have issued his 100-year bond with 100 steps. He could say in year 1, the coupon rate is 1.1%. In year 2, 1.2% and 1.3%. He could do that, but it doesn't make a whole lot of sense. Usually there's one step in a step-up coupon bond, but there could be 2 or 3. There's really nothing to prevent the company from doing that. How about these things called credit-linked bonds? All right, so what do we know? We're going to learn lots about this in the future, but let me just say that, of course, when you as the bondholder purchase a bond, you have some probability that you're not going to receive your coupon or your principal payment. So how do you measure that risk? Can we call that default risk or credit risk? I'll use those terms interchangeably now. Maybe in the future we'll maybe subtly distinguish between those two. But for now, think of credit risk and default risk as being identical. How do we measure that default risk? Well, what we do is we go to the experts. We pick up the phone and we call Moody's or Standard & Poor's. You've heard of these people. And what these organizations do is they go ahead and they rate the bond. And they do it very easily. So even a kindergartner can understand this. So the safest bond has a AAA rating, and the most risky bond has a single C rating. Of course, they go down to D. A bond that's rated D is one that is in default. So how about if we issue a bond that fluctuates with the credit rating? So maybe we're a medium-sized company and we have a triple B rated bond, and we're pretty sure that Moody's is going to increase our rating over time because we have this super profitable project that's going to take off in 2 or 5 years. So we'll just increase our coupon payment when our credit rating is upgraded. Or on the other hand, we can decrease our payment. This is what I was saying earlier about Walt Disney giving its bondholders tickets to one of its theme parks, a payment in kind bond. That really doesn't work this way. But what Walt Disney will do is, instead of giving the bondholders cash, Walt Disney will send the bondholders more bonds. And so that's why we have in bolded there additional amounts of the bond issue instead of a cash burden. And so what happens here? What happens is that over time, the total bonds outstanding increases, but today it's less because the corporation is trying to get away with issuing fewer bonds to finance the purchase of its asset. Now, some bonds can have a deferred coupon time period, so they'll say something like, hey, you know what? Send us your money today. We're going to invest in this super project over here, but we're not going to pay a coupon. So we're going to have a 0 coupon for 5 years. But then in year 6, we'll pay you a 6% coupon. So a deferred coupon bond just means that the coupons begin at some time in the future. Now, in the extreme example, you could have a 0 coupon bond where it starts out at 0 coupon and stays at a 0 coupon bond. Now, remember I said earlier that some of these things can get really cool. Here's one of these cool things here, an index-linked bond. So let's suppose that I borrow some money from you guys, you're my bondholders, and I invest in this super asset over here. And I say something like, hey, look, I'm not going to promise you a fixed coupon rate. I'm not even going to promise you a step-up rate. What I'm going to do is I'm going to say whatever the coupon rate will be is going to be a function of something else. You ready for that something else? How about the something else being the price of gasoline in the state of Alaska? Or how about the GDP in the state of Montana? Or how about the return on the S&P 500 index? Or how about the earnings that I generate over the next 3 years? And we'll take an average here. So these can be linked to inflation. They can be linked to energy. They can be linked to almost anything. And sure, I promise you that those of you, and I'm sure there are tons of you out there in the financial services industry, there are people out there thinking of, all right, what can I link these bonds to? And maybe you're saying, oh, let's link it to the rate of return on the Pink Panther diamond that Jim said earlier. Of course, it's priceless, so you can't really calculate a return on something that's priceless. Remember, I used the term embedded options a couple of times in this recording. What the reading refers to these things as contingency provisions. So these are provisions that are enacted only under certain conditions. These rights are called options. So there we go. Embedded options. They can be callable bonds, they can be puttable bonds, and they can be convertible bonds. And so let's go through these here. Callable bond gives the issuer, so this is Walt Disney, or this is Coca-Cola, or this is the federal government, the right to force the bondholders to sell the bonds back to them before maturity. And this occurs almost exclusively during periods of falling interest rates. And this is no different than what you or I have done. I ask my students this. I say, hey, ask your parents what kind of a house they would have bought back in 1981, somewhere in the United States. And those of you who are in the United States, now I know a lot of you are younger, so ask your parents. Maybe you'd have to ask your grandparents. If they'd have bought a house in 1981, mortgage interest rates were 16% or 18%, so the house would have been, you would have bought a teeny weeny house. Teeny weeny, by the way, is not a finance term. So what happens? We had the great Paul Volcker attack inflation, back in the 80s. And so what happened? Inflation came down, interest rates came down, so that by, 6 or 8 or 10 or 12 years later, mortgage rates were substantially lower than 16 or 18%. So what did we do? What did your parents do what did my parents do? Well, they refinanced their mortgage. And so this is what a callable bond is for. When interest rates fall, it allows the corporation or the government to force the force the bondholders to sell their bonds back to take advantage of lower interest rates. Now, from the bondholder's perspective, this is not good news because look, when interest rates fall, we know that bond prices go up. And so a bond that was issued at a 16% coupon rate that yield to maturity now is just 6%. That bond price might be $1,200 or $1,300. But the issuing company doesn't owe you $1,200 or $1,300. All they do is owe you $1,000. So that's what that final arrow point means. From the investor's perspective, there is a higher level of reinvestment risk associated with buying a callable bond. So when a firm or a government issues a callable bond, the bondholders, they ratchet up that yield to maturity and they're willing to pay a lower price as protection against the bond being called. So you might say, well, why would the bondholders buy a callable bond? And the answer is because they can pay less for it. And then your follow-up question might be, well, what if interest rates are going to fall? Aren't bondholders stupid to buy a callable bond? And the answer to that might be yes. But the answer might be, well, wait a minute, there are other embedded options out there, and there's a puttable bond. So this gives the bondholder the right, but not the obligation, to force the issuer to repurchase those bonds. And this has occurred during the case of rising interest rates. And so think of callable bonds and puttable bonds. Here, let me go back here real quickly. So notice what we have in parentheses, right? It benefits the issuer, callable bonds. Here, puttable bonds benefits, did I say that wrong? It benefits the issuer, and then here, the puttable bonds benefits the investor. And then convertible bonds, this is the right but not the obligation to convert the bonds into shares of stock, and those number of shares of stock will be outlined in the bond indenture. But a convertible bond is good for both sides. It's good for the issuer because bondholders are willing to pay a higher price for the bond because they might be able to share in the profitability of the corporation at some time in the future. And then the bondholders might benefit in the future because they might trade their bonds in for shares of stock. So suppose that the stock price today is $100. And in 5 years, you can turn your bonds into, let's say 1 share of stock. But in 5 years, let's suppose the share of stock is worth, let me pick some crazy number, $10,000. So you can buy something for $100 that's worth $10,000. So a convertible bond benefits both. And that takes us through all these LOSs. This was super fun for me. I hope you guys enjoyed this, and knowing that this is really just the foundation for learning the next series of readings. So in future readings, we're going to take a look at some more of these details, but most importantly, we're going to learn how to price a bond and to price all of these different kinds of bonds, and then we'll talk about risk as well. So lay the foundation. So what did I say in that very first slide deck? Know the answers to the following questions. Who issues the bonds? What do they do with the proceeds of the bond issue? And then what impact does all of this stuff have on the bond holders? So thank you for watching and good luck studying.